Ladies and gentlemen, we have drama out there. Welcome into the reaction channel, folks. Finally some action everybody's been looking for a little bit. Dow down 500 plus here today. Nasdaq down over 2%. VIX skyrocketing 20+% here today. The 10-year yield going down substantially here today. So a lot of drama out there. We'll talk about, I just want to share my opinion perspectives on the jobs data and kind of what this means for the market moving forward at the beginning of this video. And then I want to react to some things in this one. First one up here, I want to react to this video from Goldman Sachs talking about the jobs report, making it more likely the Federal Reserve cuts in September. Dan Ives in an incredible outfit there. This is the resilience or renaissance of growth that's about to happen at Amazon. Amazon stock down huge here today, down 8+%. We'll speak about if Amazon's a great buying opportunity. I'll share my projections for 1000X or on 1000X. That Amazon, where I think Amazon stock's going to over the next 4 years, essentially. I'm going to show you the growth rates. I'm going to show you my bullish case, my bear case, and my base case for Amazon in this video here today. So we'll talk about all that. Then I'm looking forward to reacting to this one. Amazon has a tough road ahead of them, so I thought this would be fun to react to a bullish analyst on Amazon, right? And then a bearish one. So looking forward to sharing my opinion and perspectives there. A lot to get into. Appreciate y'all joining me as always. One thing all I need from you guys, smash the thumbs up button. That's it. I'm in New York City right now recording this for you guys, and all I need is one smash that like button. And if you want to be subscribed to the channel, you can certainly subscribe. We are now at, I think it's 104,000 subscribers here on the reaction channel. I appreciate y'all for being here as always. Pin comment down there today if you're looking to join my Patreon. I'll put that as a pinned comment. I actually just posted in there a bit ago. Looks like about 489 people have seen it so far. And I bought 2 stocks, and I recorded the Patreon a video in there going over their entire portfolio, all that good stuff. So if you're in my Patreon, make sure you check that out. If you want to join my Patreon, there'll be a pinned comment. That's different than my private stock group, by the way. Private stock groups, access to all my course curriculums, 1000xstocks.com, the private Discord chat, all that good stuff. That's different. But the Patreon's great for a lot of folks out there, so that will be the pinned comment down there, okay? Alrighty, so what's my opinions on the jobs data in that whole debacle today? Listen. I'm not surprised at all. I'm not surprised at all. There's always talk the government's cooking the data, and, to see the numbers come in as bad as they came in today, yeah. Sad. It's sad it's got to be that way. The data should be accurate, and it's just not, right? And, it's not like this is new, though. That's the thing. Now, you can make an argument that it's even more extreme than it's been in the past. That's an argument that can be made, but this isn't new. Now, additionally, you can make an argument that if the Fed had this jobs data, that they would have already cut interest rates. There's an argument to be made there. But things are weird because it's getting political. Trump's out there, trying to say the economy's super strong, but yet he wants to lower interest rates. And that's a tough debate to make there. If they just admitted to the weakness and whatnot, then you could actually get interest rates down substantially. But by talking up the economy, oh, it's so strong, so incredible, we're doing this, doing that, it makes, I feel like, the Fed even more content with keeping rates the same. Because the Fed knows one thing. The Fed knows to lower rates when the economy's bad, right? That's one thing they know. So if every day you come out and talk about the economy is so strong, strongest economy, look at the jobs data, it's been so good, right? Oh, they messed up some reports, but it's been really good. You're not helping yourself. You're making the Fed say, okay, we can be complacent. Look at it. We got the President of the United States out here talking about the economy is so strong. Why do we need to lower? That's the stance they take, right? Because the only time they really lower is when the economy is actually in trouble. And then you got the President of the United States saying, oh, we're so strong, we're doing this, doing that. The Fed's just not in a hurry at all. And they should be. The Fed should have already been lowering for a while now, for the last 6 months. And the fact that they haven't been is definitely, now we're seeing they should have been lowering this whole time, but I don't know, man. So anyways, let's react to this one, Goldman Sachs.
Here on Jobs Friday always, but in particular, give me your reaction not just to the number for July, but the revisions, of course, which we've been focused on.
Yeah, I think it's the revisions, the July payroll number, and also the household survey, which also shows quite a bit of softness. So a couple of weeks ago, we wrote a report with the title Stall Speed. We had only a little more than 1% growth in GDP in the first half. And with this jobs number, I think that brings the picture to a more, clearly sort of stall speed image. I'm looking at an economy that is still growing, but it's growing very slowly, and the unemployment rate is drifting higher gradually. But I do think that the downside risks in the labor market, which Chair Powell did talk about in the press conference on Wednesday, that those are definitely there.
He talked about it not as much as he talked about the upside risk to inflation.
Well, he mentioned it, I think, 6 times that there are downside risks in the labor market.
And how many times did he mention upside risk to inflation? Probably more than that, no?
He talked about, the difficulty of making decisions when you are faced with this kind of shock, which raises inflation and lowers.
But does today's jobs report change the calculus?
Well, I think it makes it even more likely that they're going to cut in September. We have had a series of 25 basis point cuts in September, October, December, and to me that seems, very likely, and it could be more. I mean, it's certainly a reasonable idea that we're in restrictive territory, but these sort of data suggest maybe we should get back to neutral a little bit more quickly. We have that.
So, why is the market down big? Like, you can ask yourself this: why is the market down big if we got even closer to the Federal Reserve cutting likely, right? And the answer to that is the market has been looking for any reason to go down. The market's been on a ripper rally since April. We all know that. Everybody's been talking about we need a correction, we need a pullback. They've been looking for any reason. And so, boom, you get those revisions to the jobs data today, and you get your Christmas present that you've been wanting, right? Which is stocks to go down. Now, the question is this more than just one day or a few day phenomenon, or could we get in a multi-month, down cycle here? It's hard to get this market into a multi-month down cycle, to be quite frank. And the reason it's hard to get the market into a multi-month down cycle is, one, if you're getting closer to rate cuts, like people are going to get excited about that, right? And even excited about like Russell small caps, things like that. Like those stocks have totally not rallied for the longest time. If you get closer and closer to rate cuts, I think people get more excited about that, right? Not on a day like today when the whole market's flushed out, but when things kind of balance out there, you can see momentum in the Russell start to come in. Additionally, you're looking at these earnings; they're bangers across the board. Look. I understand Amazon stock down 8%. Look at the numbers; they were a banger. They crushed it. They crushed revenue estimates. They grew revenue almost $20 billion on a year-over-year basis. They grew net income almost $5 billion on a year-over-year basis for a 3-month span. It's incredible. You look at Meta's report this week, look at Microsoft's report. They're incredible, and those stocks matter the most in the stock market. And so to get more than a one-day or a few-day phenomenon where the market goes down and like get into a multi-month down cycle at this stage, difficult. The earnings are too strong right now. You got to get those earnings down. You get the earnings down, then we can talk about a multi-month down cycle, right? But with these companies coming in with earnings like they're coming in with, and then you still got some big dogs coming. You know who I'm thinking about? Palantir. What if Palantir sees another acceleration of growth? I don't know if that's going to happen, but what if it happens? What if they post a 45% revenue growth number? 47%? Like, I don't know. What if that happened? NVIDIA is still coming. NVIDIA is going to be a while from now. AMD is going to come. AMD, in my opinion, is going to be a banger report, but really around the guidance. Guidance specific with AMD. I think the guidance is going to knock people's socks off. If that happens, those are two of the most exciting stocks in the stock market. If Palantir comes in, smashes it, has it, comes in with a 45% revenue growth number. If AMD comes in with a crazy guide, market will bounce right back. Start in the middle of next week. So, it's just really difficult to get the market to go down multi-months right now in a big down cycle. Not impossible. You need a black swan, though.
Over a longer period of time, but you could accelerate the process.
Fed Governor Waller writes this
Oh,
morning.
and by the way, you know what stock I feel so bad for today? There's one stock I actually feel bad for. You know what stock that is? Apple. I feel bad for Apple, man. Like, they came in with a great report, man. Like, the best report Apple's come in with for the longest time. And the stock's still red today. Like, it's just a brutal day for them to have reported. Like, That's just the way it goes sometimes. You come with a banger report like they did, stock's still going down.
Taken together, the data imply the policy rate should be around neutral, which the median FOMC participant estimates is 3%. And he says not the 1.25 to 1.5 percentage points above that. Do you agree with that?
I think it's a very reasonable case, and he also talked about stall speed in that note, and I think that's the right way to look at it. Look, I think we'll obviously learn more. This is a meaningful data release, but it's one data release, and we'll want to see what the picture looks like over the next couple of months. But if we get confirmation that things have slowed as much in the labor market, then I would say, yeah, we should get back to neutral pretty quickly.
It feels like the main debate inside the Fed and out is not whether tariffs will spark inflation. We know it's happening, in certain goods, and it might increase further. The question is, should they look through it? Is it a one-off inflation increase, or is it something that they should adjust their policy to? And that's where it feels like the dissenters feel very differently than the Fed.
They should not. I repeat, they should not adjust policy based upon one-off, things like that. Like they shouldn't, in my opinion. Like they got to see through that.
And the bulk of the Fed board. So which is it?
Well, the Fed chair did say that the baseline scenario was one in which this was a one-time price increase. Now, he noted risks to that, as you point out, but he did say that was the baseline scenario. That's clearly the wallet scenario.
If that's the case, then why didn't they cut?
Because it takes a while to persuade everybody that that's the right course of action. I mean, there was never a meaningful probability of a July cut. The discussion in the committee at large has always been about September. And so, yeah, I think that's what we're looking at. And now, September, yeah, it looks very, very likely.
Jan, your team has done a lot of work on AI. I periodically ask you about it. I was just asking Sarah, though. Do you think that there's anything showing up in the data already in terms of at least the change in hiring that may be taking place as a result of the efficiencies brought to bear by enterprises adopting AI?
Yeah, I do think we're seeing early signs of it. We're seeing, for example, some weakness in technology employment over the last couple of years. Actually, as it happens, it started right around late 2022 when ChatGPT was released. We've seen a decline in technology employment as a share of overall payrolls. We've seen some weakness in the unemployment rate for young tech workers. So it is happening. So far, this is not the main thing that's driving the labor market. We're still quite a ways away from that, but we're seeing early signs.
If the Fed does start to cut in September, as you predict, and we get September 3 cuts this year is your prediction. I think the market's at 2. If we start to see that, is it in time to preserve what is otherwise a really healthy labor market and overall economy?
I mean, our forecast is that the economy continues to expand. We have a 30% probability of a recession over the next 12 months. So that's twice as big as the unconditional average of 15%, one recession every 7 years, but it's well below 50%. So yeah, that's my baseline. But I would note that the economy is growing at about a percentage point below potential. And the labor market numbers are now confirming that. So I do think that we're going to need to see some insurance being taken out.
And the consumer?
Well, the consumer over the last 6 months has seen no growth in real spending. And I'm expecting that to pick up a little bit.
So today's a perfect example of a shoot first, ask questions later type day in the market. I mean, you know how you can tell that this market is just like it wants everything lower, like go lower, right? Is what I mentioned earlier with small caps, right? Like you've seen the 10-year go down the way it's going down today, right? You've seen GSG go down the way it's going down today. You're getting, I think, after that, those jobs revisions, people are a lot more confident the Fed will be cutting in September now at this point in time. And yeah, small caps are just getting trounced, here today, right? Additionally, even look at a stock like Wynn Resorts that passed over there for just a moment, right? Like, at the end of the day, like the economy is what the economy is. Like, I don't think there should be anything new found out, with the jobs data. Like if everybody was basing their opinion on the economy based upon those jobs data, man, I got a bridge to sell you. That is right over the ocean in Nevada, man, because come on, like that's crazy. But the moral of the story is here, like a stock like Wynn even getting thrown out today, right? When 10 years going down, which should be seen as a positive for companies that have large debt loads, like resort type companies. That's just, they want out of everything today. They just want to algo selling, sell it all today, right? Alrighty, next one up here, DNI's on Amazon. Then I'll show you my Amazon projections, and we'll get into the bearish one around Amazon.
It's good to see you.
Great to be here.
So what happened with Amazon?
I mean, look, I view it as an overreaction. I mean, to me, if you look at AWS, strong. You look at ultimately guidance. I mean, guidance from a top-line perspective, I view as pretty robust. I mean, I actually believe this is sort of the renaissance of growth that's about to happen at Amazon. I think, look, you're just seeing investors hypersensitive, but you look at overall big tech earnings, monster results from the Scotty Scheffler of tech, Microsoft. You look at what we saw from Meta. You know, and even when you look at Apple, I mean, I think there's a big
although the market response to at least not Meta, but the other three, I mean, Apple's down.
Mm-hmm.
Obviously, Amazon, the worries about the guidance, 17.5% growth at AWS, but far less growth than Azure, for example. Microsoft shares did not perform particularly well either after a very strong quarter. Yeah. Concerning to you?
I mean, to me, I think it's just the beginning. I mean, look, we think Microsoft's going to be a $5 trillion market cap in 2026. And then when I look at what Nadella is doing in terms of the cloud strategy, I mean, those are Azure numbers that were beyond bull case. And I think ultimately investors, they're going to continue to try to find negatives here. But when you think about the big tech growth story and the AI revolution, I mean, this is just the next phase of growth that's now going to the second, third, fourth derivative. Apple being in another category, because right now they're essentially on a park bench drinking lemonade, watching the AI revolution go forward.
Yeah, is that why the stock? I mean, that said, they're also not spending the money that their so-called competitors are at all. They're nowhere near that on capex. But the stock down. Now, granted, we've been talking about the macro reasons today. But you would have expected with 13% growth of iPhone sales that the stock would be up.
Look, it was a robust quarter. I mean, you look at the demand bounce back that we saw in China, 4% growth. iPhone demand that's actually going to show growth into the next few quarters. But the elephant in the room is AI. Because the reality is, like, if you look at WWDC where we were, that was a back to the future, right? In other words, like,
yeah, but you got to listen. You could clearly see yesterday the market was looking to downtrend. You know, like Meta should have been up 15-20% yesterday. It only being up 12% showed like the market was looking to go lower. Microsoft lost a lot of its gains yesterday, like a lot of its gains. The market continued to weaken throughout yesterday. And so it was clear the market was looking, just give me a reason to sell. And they got it today, right? And so, you know, it's just like everybody was waiting for this. Everybody's talking about this. We've been talking about it on the reaction channel, right? Reacting to Tony's Wall Streeters talking about correction. You know, we're due, you know, August seasonality, blah, blah, blah.
They're years behind. Investors want to see them now change the status quo. They're on the treadmill. We've talked about it. Kramer's talked about it. I mean, Perplexity is the no-brainer deal. Because the reality is they're not going to have AI innovation that's going to come internally at Apple Park.
You think the market would applaud that?
I believe that would be not just a game changer. I think it would change the trajectory for Cook and Cupertino, because right now, this is the biggest tech trend in the last 40, 50 years. And when you look at what we're seeing with this arms race, from Meta to Microsoft to Palantir, and of course led by Godfather of AI, Jensen, NVIDIA, we're seeing the use cases. We're seeing an enterprise. And for Apple, you can't be on the outside looking in. And that's why I believe clock struck midnight. It's time for them to actually change.
You've always liked it.
Cook kind of, Jim Cramer spoke to him. I don't know if you saw it. We highlighted it earlier on the show. I mean, his language did seem to change a bit around M&A.
Yeah, I think there is a look, and as we've talked about, I mean, besides Beats, and you know, you've talked about it.
Beats is the largest deal they ever did, $3 billion.
Yeah. Exactly. But now they need to change because they recognize that the innovation's not going to happen internally. And their hands are tied, too, when it comes to DOJ and other, what they could do with Google and some of the other partnerships. I believe they're going to have to do not just one, but multiple deals. And that's our view. But I think if you take a step back in big tech earnings, and obviously a down day today, you feel more bullish about going into the rest of the year, which is why we believe we're going to be looking at Nasdaq 23,000, and into next year another 10 to 15%.
You feel more bullish. Yeah.
I feel more bullish because of the underlying growth in the AI revolution.
All right, Dan, thank you.
Yeah, I mean, I ran numbers, I think it was in the private stock group today on Apple, right? And I was looking over some of those numbers, and I got to say this, Apple for the first time in years is actually a decent buy. Is it the best buy in the market? Absolutely not, in my opinion. But I think it's actually a moneymaker over this next 4 years. And a pretty decent moneymaker. Like, if you ask me, will Apple outperform the S&P 500 the next 4 years? I would say probably, based upon the projections I ran that were pretty darn conservative. Now, before we get in this bearish one around Amazon, I thought I would share my projections for Amazon stock. I'm going to show you my bull case here. I'm going to show you my bear case and my base case around Amazon, and you'll see why Amazon's a phenomenal buy today, and it was yesterday, and it will be tomorrow, and next week, and next month, and last year, okay? So here we go. Here's my bull case, base case, and bear case for Amazon on 1000xstocks.com. Here it is. For my bull case for Amazon, okay? This is if things go a little better than I anticipate. I have them doing revenue growth of 14% per year, 2026 through 2029. Net income growth of 20%, 2026 through 2029 on average per year, which they should be able to get good net income lift, much higher than revenue over the next many years. They have a lot of margin expansion for this company between the e-commerce, the efficiencies they continue to find there, right? Robotics, obviously AI helping them. AWS margins should pick up from 26 to 29 quite a bit. And then additionally, the advertising business becoming a bigger component of their business overall. So we should see net income lift quite substantially above revenue. So I've been doing 20% there. 35 to 40 PE would be very fair for a company growing 14% top line per year and 20% bottom line. That puts me at a compounding annual growth rate of CAGR on Amazon of 22% low end, 27% high end, which makes me think I need to save these projections here. Save. Thank you. Okay. So now next up here is my base case for Amazon. So this is what I expect to actually happen. Okay. I expect them to do 12% revenue growth on average per year, 26 through 29. Now, I would love if they could push closer to a 20% number, but that's not my base case. I like to be a little more conservative, okay? Now, net income growth of 18% on average per year for those years. 33 to 38 P would be very fair for a company like Amazon that's as diversified as that company is, as name brand as a company is, with 12% top line, 18% bottom line growth. That gives me a compounding annual growth rate of 19% to 23%. Listen, man, if I can run a base case and get a compounding annual growth rate around 20% for the next 4 or 5 years, I'm going to take that every time. I'm going to take that every time. And what's incredible is look at my bear case for Amazon. The bear case would be very bad. I don't think there would be one happy Amazon shareholder if this situation happened. 10% revenue growth. 10%. That's it. Between the e-commerce side of the business, between AWS, between the advertising business, and everything else they got going on, only 10%, this would be disastrous. But 10%, 15% net income lift, right? That's a 30 to 35 P would be fair for a company growing at those sorts of growth rates. That gives me a compounding annual growth rate of still low double digits, 13% to 17%. Like that's why Amazon is a great buy. It was a great buy last year. It's a great buy this year. It's a great buy next year. It's a must own in every portfolio, and that's why. Let's talk a little bearishness around Amazon. Amazon has a tough road ahead for them.
When you're looking at how much investment is being made from some of its competitors in the AI space.
So the moral of the story, by the way, here, in terms of where Amazon stock is going, Amazon stock is headed to 400 plus. It's just, my only question is, does Amazon hit 400 plus in 28 or 29? That's really my only question. And 300 plus is on deck. And the only question for me in regards to 300 plus with Amazon is, does it happen in 26 or 27? That's it. So 300 plus in 26 or 27, and then 400 plus in either 28 or 29. Beautiful. Beautiful, man. You got to take that risk reward.
And you're looking at cloud, you're looking at tariffs and its business in shipping. What concerns you about the way Amazon moves forward?
I think that they have a tough road ahead of them. I'm less concerned about the cloud piece. The reality is that as their legacy customers catch up on cloud, their cloud piece, their piece of that AI cloud business will grow. I don't think it's necessarily bad that they're a little bit behind because their customer base historically hasn't used as much AI. I think that when you do see revenue from them, it's a little bit stickier because it means that their actual customers are actually using it, whereas some of these other platforms, you see a lot of sort of startups that have raised billions in venture capital that are using that money to try to kind of build a real business of their own by giving it to Google, giving it to Microsoft for their cloud compute, like OpenAI and the Microsoft deal. So I don't worry as much about AWS. I do worry a lot about shipping because those tariffs are not going to be good. That being said, the removal of the de minimis exception, I think, actually could be good for Amazon because all of a sudden Shein and Temu have a much harder road to hoe. And so I do think that there could be some upside for Amazon in that.
When you look at the fact that, for instance, Apple reporting iPhone sales went up, they said it was responsible for about 1% of its revenues. When you look at the rush to get in and purchase those iPhones before tariffs go into effect, is it possible that Amazon also benefited from some of that as well? I mean, the health of the consumer, it beat estimates here. North American revenue, $100.1 billion versus the $97.7 billion the street was expecting.
Yeah, absolutely. I think that people have a lot of uncertainty. We saw even from last night to this morning about where the tariffs are going to land, what they're going to land on. We've all seen the videos circulating the internet about people getting crazy high tariff bills over the last few months on small products. And so I think that there is a rush to sort of get while the getting's good. And I think that that's going to peter off in this next quarter. And the consumer confidence isn't at an all-time high, and so people might start watching their wallets a little bit more.
When you look at Apple,
so here's a huge mistake people are making in regards to this whole matter. Okay, massive mistake. We're talking about Amazon, a great long-term company, great long-term investment, and we're worried about what happened this past quarter and the next quarter, and how much extra did people buy last quarter versus next quarter. Come on, man. Like that's just irrelevant. Like no one's even going to be thinking about what just happened in this quarter and the next quarter 5 years from now. It's going to be completely irrelevant. What are the long-term trends at Amazon? AWS gets a lot bigger from here. E-commerce gets massively bigger from here. Advertising business gets massively bigger from here, and their other businesses get bigger. So, like you can play this game out of like, well, did an extra $1 billion or $2 billion come into this quarter that wouldn't have came in if blah blah blah. It's all going to be irrelevant, man. Though.
It benefited from that rush to buy, and as I mentioned, an increase in sales in China. Is that a
and we just talked about Amazon's on its way to 400. The question is, does its stock hit 428 or 29? Right? Listen, if you buy Amazon at 214 or 204 or 224 or 194, does it really make a difference in the end? Not much. Not much. Don't like if it went to 400 plus, you just made a lot of money. No difference than SoFi. If you bought SoFi at 6 versus 7 versus 8 versus 9 versus 10, like you still made a ton of money in the end. It's kind of irrelevant.
That you predict will be sustainable.
Yeah, I mean, the China sales are interesting. They cut prices, right? So does Apple have enough cash to be a little bit more competitively priced in China for a very long time? Yes, they have massive, massive cash stockpiles. Will the street love that they are using discounting as a strategy? I mean, we've seen this with Tesla in China as well, where when you start to have to compete on price in China, that is a very dangerous race to the bottom because the CPP is much more committed to winning that race than you are and your shareholders are. And so I do think that it's going to be tough for them to maintain that long term. But I think in the shorter term, look, when your Apple device breaks, you tend to go buy another Apple device. I don't think that's going to change, but I do think that unless they have some exciting newness in the product line, which they haven't over the last few years, it's going to feel like a really easy save to just wait another quarter or wait another year to replenish. So I don't see loads of growth in the rest of this year for them.
The other thing,
and that's a really scary part about Apple, right? The very scary part is we're talking about this shouldn't even be a subject. Discounting, price sensitivity, like that's what you do when you don't have innovation, right? As a big company like that. Like, that's just crazy. Like, they shouldn't have to even resort to that. But if you don't have innovation and people are bored of your products, like, then you got to start competing around price. That's crazy.
Remarkable is you're seeing the suppliers to Apple really benefiting. AMD, the top Apple supplier, up 81% over the last 3 months. Broadcom up 52%. Jabil up 58%. Flex up 45%, and the like. I mean, the tariffs and the weakening dollar don't really seem to matter to big tech at all. Look at the IPOs. I mean, Figma yesterday was just remarkable. I think when you look at that, it ended the day with a market cap of 68 billion almost. Started in priced at 33 and then closed at 115 and then rose to 126 in the aftermarket trading.
Yeah, there is a lot of demand right now for tech IPOs, which is a long time coming, and I think we'll see a lot more. But yeah, I mean, big tech seems pretty immune to all of this, and we also have to remember that there is some meme stock activity, not necessarily in all of these names, but we know that the retail guys are definitely out and about right now, and so I think that it's obvious that there's just a lot of energy going into very, very, very few names. But you have to remember, it's not the best time to keep cash on the sidelines either, because the dollar is way down so far this year. And so if we're sitting on cash, even in a high yield savings account or bonds, it's just not returning like it used to. So why not put it into some of these high growth ones and make up your difference in a day or two?
So Figma, I spoke about Figma on the main channel last night in kind of my perspectives and opinions as far as that one goes. Okay, but yeah, Amazon projections, yeah, like Amazon's a buy. Like, I don't know what else to say. Like, where, you know, if Amazon's 204 next week or 224, it's all going to be irrelevant a few years from now. That's my opinion on that, right? That's my 2 cents there. Alrighty, guys, if you want to see what stocks I bought in the Patreon, as well as the stocks I buy and sell each week in the Patreon portfolio, that will be pinned comment down there. You can click on that. Join us in the Patreon. That's, once again, different than my private stock group. If you're looking for my private stock group, that's always linked in the description area. That's access to all my course curriculums, access to 1000xstocks.com, access to the private Discord chat, all that good stuff, okay? Alright, guys, much love and have a great day.